After market hours and on Friday, the Trump administration issued a stop work order on Orsted, Orsted's Revolution Wind project. That's about 700 megawatts, which represents roughly 10% of the company's growth pipeline through 2027. The project is more than 80% of the way. It was expected, or is expected still to come online in 2026. Was brought to a halt by the Trump administration. It had secured all the state level permits. It had signed power purchase agreements already. So, it really hit the stock. The stock came down 17% on the news.
Last year, Patricio and I did a presentation in Copenhagen, and one of our key themes look, offshore wind is in trouble because President Trump, for a variety of reasons, does not like offshore wind.
The bill basically would allow President Trump to really go and hit countries like India, which continue to import Russian crude.
It comes from Senator Lindsey Graham of South Carolina. This bill would allow the president, and so that's the key word, allow the president to implement at least 500% tariffs on countries that purchase Russian oil, in addition to tariffs directly onto Russia, if negotiations over Russia and Ukraine get to a state where the president makes a determination that those tariffs are now needed. Now,
so I see a pretty severe normal deflationary cycle kicking in. And now I'll also tilt over to the other C's. Copper is just starting to break down. Copper, to me, looks just like crude oil did in 2008. It spiked, and then by the end of the year, it collapsed. It's just starting to break down below supports, running around $4 a pound. And also corn. Corn's doing the same thing. It's heading lower. So crude oil is not alone.
Our main conclusion is that power consumption by data centers in the Nordics, so that's Denmark, Norway, Finland, and Sweden, for anyone who doesn't know, will triple or quadruple by 2032. That's a faster growth pace than the average in Europe, driven by three key advantages for the region. Number one, the Nordics have the lowest power prices in Europe. Second, they have the cleanest energy mix or power generation mix in Europe. And third, they also have cooler temperatures, which help with the energy efficiency.
Good morning, good afternoon, everyone. This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. On the call today, we've got 4 BI regulars joining. So starting with João Martins, who's joining from Portugal today, then swinging up to London, we've got Patricio Alvarez. Hopping across the pond, we've got Nathan Dean, our senior policy analyst in Washington, D.C., joining today. And then down in Florida here with me, we've got Mike McGlone sitting in our Miami office. So good morning, guys. Look forward to the discussion today. I want to kick off with Patricio. I asked him to join last minute simply because Orsted is in the news again. If you saw late last Friday, there was an announcement from the Trump administration relating to one of their projects here in the U.S. So, Patricio, break down what's going on and what you think it means for the company.
Sure. Thanks, Rob. So, after market hours and on Friday, the Trump administration issued a stop work order on Orsted, Orsted's Revolution Wind project. That's about 700 megawatts, which represents roughly 10% of the company's growth pipeline through 2027. Although it's important to note that probably has some read across for its other U.S. project, that's Sunrise Wind, which combined represents roughly 20% of its growth pipeline. And although we've been flagging that there's acute policy risks in the U.S., with a very restrictive permitting stance from the administration, we did not expect a project that was so far progressed. So the project is more than 80% of the way it was expected, or is expected still to come online in 2026, was brought to a halt by the Trump administration. It had secured all the state level permits. It had signed power purchase agreements already. So, it really hit the stock. The stock came down 17% on the news. And that collided with the company's plan to go for a rights issue of 60 billion kroner, which at the time of the announcement represented roughly 43% of its market cap. So that was back in August 11. The company issued these plans for an equity increase, and that was mainly to backstop the building of those 8 gigawatts it has in the pipeline. And partly one of the reasons that they went for that capital increase was also to fund Sunrise Wind. And that was mainly because they could not secure a partner to fund 50% of that project. And that again comes back to the acute policy risks. The M&A market for offshore wind in the U.S. has practically stalled. It's been frozen. So that puts Orsted in a very difficult position. Although that said, we think if the stop and restart of Empire Wind in New York serves as a precedent, that there's still a chance that some sort of solution can be negotiated in the near term.
Patricia, I just want to follow back up. You mentioned Empire Wind, Equinor's project. They had a similar snag earlier this year, and they ultimately got the green light to get going. Is that your expectation here, that the same kind of deal possibly gets negotiated? How would you handicap it? Are we actually going to see this project move forward? And what percentage complete is it at this stage?
So the project is 80% complete. That's Revolution Wind off Rhode Island, and it also brings power it's expected to bring power to Connecticut. Although I would note that both are democratic states, so there seems to be little political leverage there. But that said, if you compare this to Empire Wind was only 30% of the way when it was stopped and then restarted. So if we look at it from that perspective, I think the Danish state, perhaps, which is a 50% owner of Revolution Wind and on Orsted, will try to perhaps try and support some sort of resolution. The company is working to expedite the restart. It has reaffirmed its plan to go ahead with the rights issue, and we expect the terms to be approved in the AGM on September 5th.
All right. Thank you so much. Nathan, let's get you into the conversation. You're based there in Washington, D.C. What are you hearing about offshore wind here at the moment? The President Trump regularly speaks out against it. Is there something that Orsted or some of these other developers could do to make sure that these projects don't hit similar snags or get them back up and running as they're already nearly complete?
Yeah, so last year Patricio and I did a presentation in Copenhagen, and one of our key themes look, offshore wind is in trouble because President Trump, for a variety of reasons, does not like offshore wind. And as we've talked about in many of these calls before, also solar can be part of that. But when it comes to this project in particular, this sort of just follows the playbook of what the Trump administration is doing, where it pulls permits, it pulls funding, and for those essentially the only other way that you can combat that is you take them into court, and courts take time. I mean, we're talking years, and the courts have shown a way of deferring to the president in the interim. So even things like injunctions, a lot of the times the courts are going to the president's way. So what happens next? Well, negotiations. And so even though President Trump does hate offshore wind, and I think it's fair to use that word hate just because he said it, there's always a negotiation, there's always an opportunity. But in this case, it's really difficult to see how that negotiation plays out because of what Patricio just said. Democratic states, not exactly leveraged. This isn't something that's high on that list of policymakers really screaming for it here in Washington, outside of those individuals from Rhode Island and Connecticut. So time will tell. But again, you don't want to close the door because always something is available to negotiate.
Okay, thank you so much for that perspective. Now, Nathan, I want to follow up and shift gears a little bit here, because I'd asked you to come on today because I thought you put out a pretty interesting note last week looking at a Senate bill, I believe, that's geared towards sanctions on Russia if there's not a resolution to the Ukraine conflict. And I think the bill basically would allow President Trump to really go and hit countries like India, which continue to import Russian crude. So give us a breakdown of the bill and give us your handicapping. Is this actually going to pass? Is this something we should really be focused on as we look into the fall here?
So this bill, it comes from Senator Lindsey Graham of South Carolina. This bill would allow the president, and so that's the key word, allow the president to implement at least 500% tariffs on countries that purchase Russian oil, in addition to tariffs directly onto Russia, if negotiations over Russia and Ukraine get to a state where the president makes a determination that those tariffs are now needed. Now, so this bill is a tool. Think of it as something that is allowing the president another tool to conduct negotiations so that they can go to countries like India, China, Turkey, Brazil, and say, look, we need you to put pressure on Russia to make a deal on Ukraine, or else you're going to be slapped with at least 500% tariffs. Now, for what it's worth, today is the date that India has been slapped with additional 25%, bringing it to a 50% reciprocal tariff for their purchases of Russian oil. Should also state that there are exemptions related to technology and pharmaceuticals. So again, that hit there isn't as important as a 500% tariff. But the note that we put out last week essentially said this, is look for headline risk to come in September when Congress comes back, because this bill has 85 co-sponsors in the Senate. Most of the Democrats are on board with this. Most of the Republicans are on board with this. And so if this bill were to ever come up for a vote, I think it would easily pass the Senate, easily pass the House, and President Trump would certainly sign it. The question, however, is will this bill ever come up for a vote? Because if the bill does come up for a vote, it could be seen as a negative when conducting negotiations with Russia over Ukraine. And so I think what happens here is President Trump says, so there's two angles, one from the Senate and one from the White House. I think the White House says here is that, look, we will pursue this bill if we ever need it as a way to spur negotiations. And I think the Senate is going to be the mindset of saying, look, we're going to pass this bill. We're going to pass it. We can pass it by as soon as the end of this month, but they're not actually going to take any steps until they get their blessings from the White House that they can go forth and do it. Because Majority Leader John Thune said, even back in July, we're going to pass this by the August recess. They didn't. And so I think you're going to see some headline risk, but just please note is that this is just a tool. Those tariffs actually wouldn't go into effect unless President Trump wanted it to.
Okay, very interesting. Mike McGlone, I want to hear your reaction to this. You've had a very strong bearish call on crude for some time now. Help us parse how to think about what Nathan just said. So on the one hand, this sanctions bill could take some Russian crude off the market if President Trump is able to pressure India and other countries to not accept those flows. On the other hand, I'm hearing some big numbers related to tariffs, which could have some macroeconomic headwinds. How do you balance it all? What are you thinking about crude here at the moment?
Mostly all the latter. I just refreshed a book I started reading about a year ago, and I just really haven't finished, called Choke Points, American Power in the Age of Economic Warfare by Edward Fishman. Trump is following that prediction to a T. This is a war, it's economic, and Trump is hammering hard. So the way I look at it, let's start with crude oil. And the high for the year is 80, the low is 55. And we all see the tilt. Trump wants lower energy prices. And the last 20 years, lows have been 40 or below. And with the U.S. energy, that was with the UN energy dominance, we were a net importer, now a net exporter. And the tilt is all heading that way. And so I don't see what really stops what gets crude above 80, but I can see it easily getting to 40 potentially next year, most notably if the U.S. stock market goes lower. Then you look over what's happening to the world's largest demand pull importer, China. Their imports are stalled at 11 million barrels a day or so. They're potentially declining, switching to EVs. They have PPI running at minus 3.6%. And the 10-year yields at 1.77%. That's despite massive fiscal deficit spending, 300%, and pretty significant money supply increasing, almost double the U.S. So there's severe deflationary forces in the whole world trickling down from China, and crude oil is just hanging in there. The price right now, and the Bloomberg Energy right now index is the same as it was 20 years ago. 2005. And I see everything tilting lower because you just look at what's happening, it's still in the back end of that spike. So the problem is that I'm consensus. It's no fun being consensus, but I'll point out, I think it's still heading to 40. I don't know what stops it, some kind of shock. And the key thing that'll accelerate it is just a little pickup in U.S. stock market volatility. Remember, like you mentioned at the beginning, it's August and volatility just reached a low for the year. If the stock market stays up, yeah, crude will head lower. But if stock market drops, crude will head lower, double the velocity. Then we tilt over to natural gas. We had a very cold winter last year. Is that global warming trend going to end? Now, if we get another colder than normal winter, sure, it could. And gas already priced for that. So gas is already starting to tilt back lower. The front price, not really significant at 2.8. To me, that's the risk that heads towards 2, but it's that January contract that really mattered. It's back at 4. 4 is still very elevated. The January contract last year ended at about 350, and that's when we had a really strong demand pull because the winter was colder. The high for this January contract was 573, but what's happened that I've learned my lesson in natural gas is every time U.S. gas spikes, the supply comes back on. We rebuild inventories at a rapid pace, which we've done. The supply is coming on fast based on Vince Piazza's research. And now, to me, the risk is the market's still priced for a colder than normal winter. The risk is we tilt lower. So I see a pretty severe normal deflationary cycle kicking in. And now I'll also tilt over to the other C's. Copper is just starting to break down. Copper, to me, looks just like crude oil did in 2008. It spiked, and then by the end of the year, it collapsed. It's just starting to break down below supports, running around $4 a pound. And also corn. Corn's doing the same thing. It's heading lower. So crude oil is not alone. It's a typical downward elastic cycle in elastic commodities. Copper's just not as elastic. It's just much more industrial. Everything's heading lower. I know it sounds pretty bad, but it's great for traders. It's great for consumers. But the key thing you have to ask yourself is what stops these downward trajectories that we head towards the end of the year, we get past August, and volatility picks up in the stock market. Hopefully, the U.S. stock market goes up, because if it doesn't, copper's going to drop down to 4, crude oil is going to drop to low on the year, and corn's not going to really matter.
Thank you, Mike. I love that you always reference a book when you can. What a luxury to be able to read books. I keep seeing data that shows reading is on the decline. I love that you continue to read books, and we should have everyone on this call sort of give their recs on what they're reading at some point. Maybe I want to query you a little bit more. So for anyone listening, if you didn't see the news last week, Cenovus, a Canadian oil sands company, is buying MEG Energy. Now, their combined entity is going to have about 900,000 barrels per day of production. And Canada plays a very significant role in thinking about the North America energy complex. And a company like this is probably going to be pretty steady as she goes. You don't tend to pare back your production from an oil sands operation when prices go lower. You just keep full steam ahead. Now, the U.S. oil patch is quite different these days. You tend to see a strong response to prices. And so when you think about that outlook that you just put forward, Mike, are you expecting the shale producers in the U.S. to pull back significantly, sure, given where you think the commodity could be headed?
One of the first, I have to mention most of the books I listen to. I'm cheating, but it's easy when you hang out in Miami, do a lot of bike riding. Yes, absolutely. The number one factor I'd like to point out for years now, in all commodities, is the excess of U.S. liquid fuel and crude oil supply versus demand, and all that having to be exported. You look at that trend; it's just heading that lower. That demand versus the supply just overwhelming. And the only 2 times in basically the last 10 years that we've curtailed that supply is when prices collapse. It's the elasticity, and it's happening now. Prices are going down, and we're curtailing supply. You get it, but we've also have a new administration wants to turn that back on. So I fully expect, when we go low, when we get below that average cost of production, which we're near it now, BNF estimates around $55 a barrel, which is our low for the year, we need to shut it off. It's what always happens to commodities. It's a question when, where, and how you measure it. You got to get below, you get to the break-even cost. So to me, it's a matter of time. You get below those levels. It's already seen the signs of it. I love when people talk about drill counts, which doesn't really matter anymore, but it's the rigs and things that matter. It's just things are so advanced now that you look at rig counts, it's the same as it was in 2010, yet US is double production. But everything I hear about in the oil patches, they're starting to curtail because prices are going to lower. And there's a key factor. Price is the #1 factor in this space, and it's still heading lower. I just don't know what's going to stop that. And I'm really worried about what might accelerate it. And then the key thing sometimes, if you can go faster and get it over with. Now it's just kind of slow pain.
All right. Thank you so much, Mike. Zhao, before we get to you, I want to swing back to Nathan. And Nathan, let's get your reaction on the Canada angle. I haven't seen too many headlines lately on this idea of trade and tariff tension here between the US and Canada or the US and Mexico. But earlier this year, when some of the trade tensions were first kicking off from the Trump administration, Canada and Mexico were targeted sort of right out of the gate. Where does all that stand? It seems like everything has kind of quietly gone under the radar, and basically there's no there at the moment. But tell me, what's the actual state of play when you think about North American trade policy here at the moment?
So it's coming. And what I mean by that, and I'm being a little tongue in cheek here, but there's some truth behind it, is that a lot of the folks that are negotiating on this over at Department of Commerce and U.S. Trade Representative, they were exhausted from trade deals with the UK, with the EU, with China, the negotiations that were taking place in Geneva. And so, being tongue in cheek, but a lot of them did go away to the beach in August, but it's coming back. We've seen different styles, though, from Mexico City and Ottawa in terms of how they're engaging with President Trump. Mexico City has been taking a little bit more of a olive branch approach, have conversations. We've seen President Trump be a little bit receptive to that. Obviously, former Bloomberg chairman Mark Carney, now Prime Minister of Canada, has been a little bit more confrontational. But even, Joe, just last week, there was a phone call between President Trump and the Prime Minister about how to start those negotiations and have a working relationship. So I think, you're going to see September be very, very busy from a news cycle perspective up at Capitol Hill. And I'm pointing because Capitol Hill is this way because of funding fights, government shutdowns, and so forth. But come October and November, December, the White House is going to be more busy because I think a lot more of these tariff negotiations are going to pop up. Because let's remember that we only have deals which are essentially memorandums of understanding. These are bullet page points. It takes years to negotiate these deals. And so as President Trump continues to think that these tariffs are effective, and these are his views, he's going to continue to push for more things. I would just state, though, is that when it comes to Canada and Mexico, a lot of it is already USMCA approved. And look, I mean, if you were to ask what is USMCA approved versus not, then we would have to bring out one of Mike's books here just to figure that out. But, again, the USMCA negotiations will have to kick off. So I think that's going to be a 2026 thing we're going to be talking about that for the next few months and years.
All right. Thank you so much, Nathan. And for everyone listening, I just want to appreciate that you're dropping comments into the chat, sending questions. Thank you for that. We will try to get to some of the ideas that are on your mind. But first, I want to get Zhao into the conversation. He's got a note out this morning looking at this great theme that we've been working on around data centers and energy demand. And Zhao, you actually dove into this question as it pertains to the Nordic region in Europe. So tell us about your note. You've got some very cool charts. Want to make sure everyone sees it, but tell us some of the key takeaways that you and Patricio determined when you took a deeper look there.
Sure. Thanks for the introduction, Rob. So as part of our AI series, we've now looked at the Nordics market, which is a market where we think that has key advantages for the build out of data centers. Just to throw it out there, our main conclusion is that power consumption by data centers in the Nordics, so that's Denmark, Norway, Finland, and Sweden, for anyone who doesn't know, will triple or quadruple by 2032. That's a faster growth pace than the average in Europe, driven by three key advantages for the region. Number one, the Nordics have the lowest power prices in Europe. Second, they have the cleanest energy mix or power generation mix in Europe. And third, they also have cooler temperatures, which help with the energy efficiency. Now, just for context, the Nordics have about 1.4 gigawatts of IT capacity, data center IT capacity currently, and a pipeline of 7.5 gigawatts. And we think there's really high visibility in this pipeline. That's highlighted by two high-profile projects. That's OpenAI's Stargate in Norway, which is a 500 megawatt project, and Brookfield's project in Sweden, which is 750 megawatts. We look at these two projects alone and assuming they're nearly fully efficient, meaning all of the power that they use is for the data consumption and not for cooling and other things. Even under those assumptions, those two projects alone might almost double the data center power consumption in the Nordics. Now, those three key advantages are really important. We always talk about how the US has much lower energy prices than Europe, but actually the Nordics within Europe have something between a 45 and a 70% power price discount versus the rest of the continent. So 45% against Spain and anything between 65 and 70 against the UK, Germany, and Italy. And within the Nordics, there's regions where power prices are nearly 90% lower than the rest of Europe. Where Stargate is going to be built, that's a region where the power prices averaged 10 euro a megawatt hour over the last 12 months, which is unthinkable in Europe. So that's one key advantage. Then for data centers, on an average data center, about 30 to 40% of power consumption might be for cooling. And what we find is that in the Nordics, that's much lower. That can be something like 10% or even lower, because in the Nordics, temperatures are much lower. So you can use free cooling techniques. They're so-called free cooling techniques, which is essentially you just cool the data center with air from outside, or even water from the fjords, there's a couple of data centers that do that. There might be some environmental implications of that as well. I'm not sure, but that's another key advantage. And then second, 95% of the power mix in the Nordics is either from hydro, nuclear, or renewables, and that aligns to the sustainability goals of these hyperscalers. So based on those three advantages, we think there's great upside for this market.
Thank you, Zhao. A couple questions come to mind. First, I'm curious because here in the United States, there's this big conversation about the impact that data centers are having on power prices. For those unaware, power prices have been rising at a pretty fast clip, faster than inflation. And I think there's general concern, no matter which market you're looking at in the US, is how much these data centers could push power prices up. So given that power prices are already lower in the Nordics, are the regulators giving them that prevailing power price, or are the data center operators and builders having to pay a premium off of that already low price?
So for now, it seems that they're getting market prices, but there's already been some backlash due to the size of these projects. For example, Stargate Norway, which is going to be built in their pricing zone 4, which, as I explained, has average prices of 10 euro megawatt hour. That's like a 2/3 cheaper than the average in the Nordics, 90% cheaper than the average in Europe. And the reason for that is that this is a region with a lot of hydropower production, very constrained transmission capacity to the rest of the country. But that also means that it's a region where this project is going to capture a huge portion of demand, and is obviously going to have an impact on power prices. So although there's not been any specific measures to counter this, that's definitely already led to some comments, some political comments, and some political backlash. So that's something that we're going to have to keep an eye on.
Thank you. And just a quick preview, tomorrow or possibly the day after, we have a note in the works, the same theme. We're drilling in on ERCOT. Let me just say, everything's bigger in Texas. Sorry to throw a little bit of cold water on you there, Zhao, but we've got some big numbers coming out of Texas, and we're going to drill down into that market next. Patricio, let's swing back around to you. Okay, you've heard the discussion here on the call from Nathan and from Mike. One of the things you also cover under your remit is the European gas market. Give us your latest read. Where are we at on the European gas story at the moment? How's storage looking? What's your winter outlook shaping up like?
Sure. So I think this pretty much follows the same trend that Mike was talking about in terms of deflationary forces, excess supply, and weak demand. So European gas prices are still hovering around the 33 to 35 euros per megawatt range, with storage reinjections going pretty on track to pretty much on track to be over 86% full by the end of October. And although that is below last year's record, I think it was over 95% last year. It puts Europe in a good place to face a higher winter demand. Like Mike said, we faced two consecutive warmer than average winters before the last one. The last one was a bit colder. It was surely like mostly within the range of the norm, the last one. So we have a normal winter this winter. We should exit next March above 30%, which is sort of in range with the historical norm. In terms of the supply outlook, demand weakness in China. So China has demand for LNG has declined by 19% in the first 7 months of 2025, and we think there's only a very little chance it will rebound meaningfully. We only expect a couple percentage points of rebound into next year. So the LNG market looks fundamentally loose. There's also additional U.S. capacity set to be on streamed in the fourth quarter and into 2026, which would potentially loosen it further, meaning that Europe will have to have less competition to get those spare cargoes for LNG. We flagged some downside risks as well from the Russia-Ukraine peace talks. We think that if there's some resolution to the conflict, that there's scope for some pipeline flows to return into Europe. That would be mainly the flows via Ukraine. So that's 15 billion cubic meters a year, or roughly 5% of what the total supply base is in Europe. So all these indicators tell us that we are well supplied, although 30 to 35 seems right in the near term. We think if sort of the winter fears of supply melt away by the time we start winter, perhaps prices would actually cool even further.
Okay, thank you, Patricio. Mike, I want to come back around to you and get some perspective on everything we've just heard here from the team. One of the enduring things I think you kind of hear across the thread here is a movement towards lower emitting fuels. So more gas at the expense of other things, more wind and solar, even if there are some political hiccups along the way. And when you were talking earlier, you mentioned some of the other metals commodities. And so for some time, you had folks like Jeff Curry out talking about a super cycle for copper and other things because of energy transition investments. And I'm curious, does any of that thinking feed into your maybe not 12-month outlook, but your 5-year outlook? How do you think about that nowadays?
Absolutely. And Jeff is somewhat of a friend. We used to be neighbors in Connecticut and cross paths a lot. In defense of Jeff, oftentimes he's brought out when commodities are on major tears, and he just says the same thing. But he's more of a big picture macro guy. And oftentimes I've made decent calls just taking the opposite side when they take them out, because you bring them out when market's at peak. So the key thing about copper to remember is it's a known. I mean, it's just like all this demand that we're going to be getting for energy. Those are known knowns. Everybody's got it in their models. It's priced in, and to some extent, if it's unexpected things, I'm not worried about. And that's why, to me, copper's so important. And what just happened in copper, I fully, one thing about copper is I fully expect it's going to continue to outpace the price of crude oil over time. It has for almost decades now, partly because we have this energy transition that we spoke about, and even Patricio mentioned, we're all mentioning. But that's why it's so important. But what happened this year was a major shift. And I think in the shorter term is I got to get at least through the next 3 months. If copper can stay at right now, at least for a few days, it was at, put a record in this year. Let's talk about U.S. copper. It's distorted by tariffs, which is the most significant thing. But it was for a little while also ready to close at a record high for the year. That's about 446. Right now, copper's at 439. And to me, the pattern I've seen and what I've seen happen in the markets, when you drop 20% in 1 hour and you run through stops like that, just my experience in markets is you run through markets, you put in peaks that could last for decades. Crude oil did that in 2008. That's what I'm worried about. Yes, everybody gets the big picture macro, all the demand, electricity, and all that for copper. It's more shorter term. I'm worried about. Let's get through that first. So absolutely long term. The key thing is from a U.S. So there's energy. I think obviously that's part of what silver is doing. The silver is more industrial, but the key thing in this in the U.S. and as you talk about natural gas is okay. I get it. There's more and more demand for electricity for natural gas. Yet most of the demand for natural gas is for heating. Again, that's priced in. And the problem is, let's see it. Let's see. Show me the beef. And I'm seeing the opposite. Like I said, we see that spike in the Jan contract to 571. Right now, it's running around 4, and it's got to sit there and wait for. We better get that colder than normal winter against global warming, or it's going to drop down to maybe 2.60, which is what Jan 2024 did. So I'm more worried. Yeah, macro, big picture, but all that stuff can change in a heartbeat. And just remember, prices you see on your screen, if it's a known narrative, but everybody knows what the narratives are, more demand electricity, it's priced, it's on the screen. It's what changes those narratives and what gives me normal earlier indications. Right now, to me, the next 3 months of this year are going to be really telling. And I'm just hoping we get through it without a pickup in volatility. So I'll end with this. Volatility is what matters. The number one metal that's going up on the planet is gold. And gold's pulling along almost all the metals, most notably precious, platinum, silver, and palladium. At the same time, what we've seen is happening is, let's look at the macro big picture. To get through this paradigm shift of the U.S. president, and we know what he's doing, and not have some more volatility in the market to be unlikely. So 200-day volatility, 200-day moving average of the VIX is running around 19. When he was elected in November, it was around 15. It's heading higher. To me, that's the risk, is it's going to be right, and the stock market's going to head lower. That is the number one force in everything. And the U.S. stock market is so expensive, and I think gold's figuring it out. So that's why I'm still sticking, still based on beating the rock-beating stocks, and then everything else kind of trickles from there. And maybe natural gas can stay the year above 4. I doubt it.
All right. Thank you so much, Mike. One more question for Patricio and Zhao. We'll keep it energy transition focus as well. So over here in the U.S., Secretary of Energy Chris Wright has really been talking a lot about nuclear in over the last few months, and that seems to be the Trump administration's answer for thinking about the future of energy. And so I want to come to you first, Patricio, because I know you've been looking at this from a European angle. What's the timeline for nuclear look like? Is there any way that the U.S., in your mind, could actually accelerate nuclear? Are there any examples in Europe or elsewhere that you could point to that suggests nuclear could be put on an accelerated timeline?
Sure, that's a great question. I would say let's start with the U.S. Like you mentioned, the U.S. has a more supportive regulatory framework for nuclear, with the U.S. administration's target to reach 400 gigawatts of nuclear by 2050, which sounds very ambitious. Our colleagues in the U.S., our utilities team in the U.S., their forecast goes up to 160, I believe, which is still very, very ambitious. But we do know that policy there is more supportive towards nuclear. That said, one of the designs by NuScale has already been approved by regulators. So there is a chance that that the deployment of small modular reactors could accelerate from the start of the end of this decade, from the start of the 2030s. And small modular reactors would resolve some of the issues that the larger models face. Larger models tend to take 7 to 10 years, tend to face cost overruns, delays, design changes. So a small modular reactor, in theory, would solve a lot of that because it can be put in a production line and be deployed, as it says, through modules. The picture is a bit less favorable in Europe, I would say. There's a poor track record of large scale construction of nuclear reactors in the UK and Europe. The latest example is Hinkley Point C, again facing multi-billion cost overruns and project delays. And when we look at the next generation nuclear, so the SMRs here in Europe, I would say that the regulatory process for those new models is perhaps lagging the US. Our expectation is that models by the likes of Rolls-Royce could hit the market by the mid 2030s, so 2035, 2037. And if that that pans out, then nuclear could see a long-dated renaissance to 2050. And I would say, if there's the speed of the demand upside from AI, it's pretty much a race. Our colleagues from the global tech team in the US actually have updated their capex projections for the big tech's capex projections, and the new forecast actually looks more front loaded. They are accelerating, investing even harder. So perhaps nuclear will be late to the party, but we do note that the data center power demand will only be a relatively small portion of the whole electrification story. So especially in Europe, if you look at what power demand has done over the past 2 decades, it has declined by about 1% per year. And the REPowerEU and policymakers in general, the expectations from all the network transmission operators is that electricity demand will increase by roughly 20% by the end of the decade. Data center demand will probably just be a slither of that. So we do know we still need nuclear, but it's just gonna take 10 to 15 years to come back.
Thank you, Patricio. I've enjoyed watching the blinds go up and down behind you. I think that's on some kind of automatic timer there in London. And just quickly, for anyone listening, if you are not in any of our client chats for BI, we have some very active chats, just like the webinar chat here. You can join those, and it's a daily discussion of all things energy. And we've got 2 separate ones. One's a little more traditional energy focus. One's a little bit more energy transition, clean energy focus, but they're both great. Encourage you to join them. Also, reach out to any of us if you have any questions. We're all green dots on the terminal right now, and we're happy to chat about any of the topics. And with that, Zhao, I want to come to you for last word today. You cover some of the European renewable developers. And if the outlook for renewables in the US is going to potentially be a little bit more muted, at least over the next few years under the Trump administration here in the US, does that mean they need to pivot a little bit more and invest more in their own region, or perhaps other parts outside of US or Europe? Where are they going to go for their incremental electron capex?
Yeah, that's a great question. I think we'll find out the answer over, I think, the next 6 months. A lot of these developers are going to update their investment strategies, and I think we'll get the answer to 2 things. First, how much can they still build in the US under these new rules? And as you mentioned, that's going to decelerate, but that's not going to go away. A lot of these peers have safe harbored projects, and although that might the run rate of additions might slow down, most of them, except Orsted, as we spoke about in depth, most of them are focused on solar. And our house view is that that's going to continue to grow. So as long as they can safe harbor a little bit more capacity, they'll continue some sort of stable run rate in the US. In Europe, things are a little bit rosier in the sense that there's not such a vocal adverse policy narrative, let's say. And we continue to grow on solar, on wind. Those are the cheapest technologies here. And if we're going to beat some of these forecasts that Patricio mentioned for power consumption, the answer is going to have to be through solar, wind, and gas, because everything else, well, nuclear is going to take too long, coal is being phased out. So these are really the three technologies that can meet that. In Germany, we'll build a little bit of gas, but outside that, most of the gains are likely to be for renewables. So that's a region where these companies might have scope to refocus on. Some of them have nascent footprints in India and Southeast parts of Southeast Asia, and there might be scope to invest there as well. But that's a little bit less unclear. Australia is also a nascent market, which regularly features into an initial narrative from the developers, but then has not yet materialized, but that's something to watch out for. But I will say a lot of these developers have deleveraged or are deleveraging their balance sheets. So we don't think about it as just, if they're not investing in the US, they'll invest in Europe or somewhere else. It might just be that they're just not going to invest a big portion of that amount.
All right, we'll leave it there. Thank you, everyone. Nathan had to hop off early to go do a radio hit, or we would have given him the final turn on the mic here today. But I want to thank everyone for joining us this week. I hope if you're based in the US, I hope you have a great long weekend. And please do join us next Wednesday, same time, same place, every Wednesday, 10 a.m. New York time. We get the band together. Sometimes we have external guests, but we always talk about all the things that are topical in energy markets, and we welcome you to stay and participate and be a part of the Bloomberg Intelligence energy community. Take care, everyone.